Abbott, you think I will?
Hello. Hello.
Hello, sir.
Mm-hmm. So why they are annoyed or what?
Oh, sir, they are not annoying. They are joining.
Okay. You can have about 4 people joining. Hey, 6 people joining. You can start so that others can join. Oh. But the Edupocus internet is also not stable. It just comes and go. It comes on and off. Monson,
Yes, Doc.
is it? You are from Post Center.
West school, West school.
Oh, okay. Timna, your internet is disturbing you.
I said, no, my internet is not disturbing. When I tried to get some colleagues to join.
Ah, okay.
I said, I think we can start.
With 3 of you,
Yes.
with 4 of you.
Yes, sir.
Okay. I think the last time we talked, we got to unit 5 of session 5 of unit 4. That was a cash budget. And so we have looked at the budget. There were some of the self-assessment questions you have to go through. But this aspect of budgeting is also very important. So I just want to just take you through shortly before we can proceed to unit 5. What we talk about, that is budget control, budgetary control, and behavioral aspect of budgeting. You know, budgetary control has to do with the preparation of the budget and the use of the budget in guiding performance of the businesses. There's one thing preparing the budget and another thing using the budget to actually control activities. In Ghana or in the world, Africans, we are very good at going for meeting and making plans, preparing budgets. But as to whether this budget is going to be implemented is another thing. So budget control is an aspect that we have to be very mindful of. If we want to get the budget to be successful, we have to ensure that the budget is prepared and then properly used to control activity. So before that will happen, we have to be able to look at this budgetary control and the behavioral aspect of budgeting. The behavioral aspect of budgeting is that it's a human being that prepares the budget, and the budget should be a guide for actual performance. Okay, but last time I think one of you asked whether if there is an expenditure that has to be incurred to ensure that the business succeeds, or that is very necessary to see the success of the business. Should it not be spent because we have budgeted? So that is the behavioral aspect of budgeting. The budget should not be seen as a mechanistic type of thing or a strict thing that we cannot even, make a change when we know clearly that maybe the budget estimates were no good. So that is the behavioral aspect of budgeting. Also, the people who are preparing budget themselves have their aim. The departments, managers have their departmental goals. And then all this has to be married into the organizational goal. So if these things are not managed very well, and we don't take the human aspect of the budget, and we just look at the budget as a mechanics or a mechanistic type of thing that should guide, and then strictly go by that, then we are not going to succeed. So this aspect is very important that you need to know. So by the time we finish going through this session, you should be able to explain the concept of budgetary control and also state and explain at least 3 behavioral aspects of budgeting. Now, so what the concept of budget control, what is it about? According to the Institute of Chartered Management Accountants, they define budgetary control as the establishment of budgets relating to the responsibility of executive to the requirement of a policy and the continuous comparison of the actual with the budgeted results, either to secure by individual action the objective of that policy or to provide a basis for its revision. So we prepare budgets, and the budget preparation has to do with the various departmental managers who are the executives of the various departments. They prepare their budgets with the requirement of the policy of the organization, the budget guidelines that have been given. That are the policy that is guiding them to come out with their budget. And after they have prepared the budget, relating to the responsibility of the executives and the requirement of the policies of the organization, this budget must be continuously be compared with the actual results that are occurring. Now, the idea of comparing the budget with the actual result is either to secure by individual action the objective of that policy. Because when you are preparing, we want to see whether the policies from which we have come out with the budget, we are achieving the objective of that policy, or if we now find out that we do the comparison and now find out that we are not achieving the policy, or the actual activity is not going the way the policy recommend, and the use of the budget to control or to correct from the actual deviations of the actual with the budget. The main purpose or the import of this definition given by the Institute of Chartered Management Accountants actually stress on the fact that individual managers are held responsible. Hello? Hello?
Hello, sir.
Yes, I thought somebody want to ask question. So we are saying that the purpose of comparing the budget here, which is given by the definition given by the Institute of Chartered Management, so the comparison is done so that if we realize that the actual deviate from the budget, which means there's going to be a variance, discrepancy. We call that one variance between the actual result and the budgeted the result. Okay, if that happens, then the managers who are responsible will then take remedial action to ensure that corrective measures are taken to marry or, bridge the actual performance or actual result with the budgeted. The execution of budgetary control may be the responsibility of the budget committee. Most of times in many organizations, it is the budget committee that seek to the execution of the budget because we are saying that the responsibility of the budget committee is to see to the preparation and implementation of the budget. So it is the duty of the budget committee to see to the implementation or the execution of the budget. But in most cases, the detailed work of the communicating the variances or variance information and coordinating planning and control effort organized on behalf of the committee by the budget officer. So it is the responsibility of the budget committee to ensure or see to the execution or implementation of the budget. In that case, by implementing the budget or executing the budget, we are trying to ensure that actual activity conforms with the budget. However, this responsibility of compiling or providing detailed information or communicating the variances, and here the variances, we are talking about the difference between the actual results and the budgeted results, okay, or the budgeted figures. These are normally those variance information are normally coordinated, planned, and controlled on behalf of this budget committee by the budget officer. And in most of these cases, the budget officer is the accountant. Okay, is the accountant, or the accounting department may do so. So if it is not that, so sometimes if it is the account officer, the chief accountant or controller, whatever position that it is, or the senior person in the accounting department, he seeks to provide this deviation between the budget and the actual result and make this information available to the various responsibility managers to take remedial action. So the costs or management accountants will normally prepare the periodic statement of variances and ensure that managers responsible are aware of the need to consider control action about particular variances which have arisen. So if we have a management accountant or cost accountant in that particular department, then it will be the responsibility of the cost accountant or the management accountant, or if it is cost and management accountant, he will be responsible for preparing or coming out with this periodic statement of variances, differences between the actual and the budgeted estimate, to ensure that managers who are responsible are aware of these deviations that are occurring, so they can put in place control actions to address a particular variances that have arisen between the budget and the actual results. Hope you are following me. So that is budgetary control. The wrong approach to budgetary control is to compare actual activity level with the fixed budget. However, the correct approach is to first identify fixed and flexible costs, fixed and variable costs, and secondly, produce a flexible budget. It is preferable to use flexible variable costing techniques and keep fixed costs at the same amount in the fixed budget as in the original master budget. So what we are saying is that in undertaking budgetary control, it is wrong approach to compare fixed budget with the actual results, where fixed budget will be a budget prepared for a given level of activity, and when actual activity deviate from the fixed budgeted activity, you will still want to compare the estimates in the budget with the actual result, whilst the actual activity is not in conformity with the fixed budget. So the better approach or the correct approach to do here is, flex the budget to flex the budget to take in consideration the actual performances, so actual activity, so that the variable aspect of cost in the budget will go in line, they will be in line with the actual results, actual activity produced. And those fixed costs, which we know that they will not change irrespective of the level of activity, those ones will remain fixed. So flexible budget is a budget that is prepared to reflect that is prepared to change with the level of activity. Remember that we have defined what fixed budget and what a flexible budget. So if you know the clear difference or the definition between the different definition of fixed budget and flexible budget, you will see clearly that fixed budget is a budget that is prepared to remain constant irrespective of the level of activity, whilst flexible budget is a budget that's prepared to change proportionally or to change in proportion to the level of activity. In this case, to be able to make proper control or to ensure proper budgetary control, you should be able to prepare flexible budgets. That would be the best way of doing things, so that if an item cost element is variable, it can be changed to reflect the actual activity, but fixed cost element will remain constant, so that you can actually compare the actual activity, the budgeted estimate for that level of activity, so that comparison will be done very well. For example, if you have budgeted for 10,000 level of activity, sales revenue, material cost you use, labor you use, variable production overheads, these are definitely variable. They are variable in line with the level of activity. Therefore, if actual activity now from 10,000 reduced to, let's say, 8,000, you cannot expect the sales revenue for 10,000 units to be the same as the sales for the 8,000. In that case, you have to flex, get the cost, sales per unit, material cost per unit, variable cost per unit, any variable cost. You calculate the per unit cost, then you can multiply by the actual level of activity to get the budgeted flexible budget, and that you can compare with the actual result. That is what is done. Okay, so that is the next thing. So you have to now think of the purpose, advantages, and disadvantages of budget control. What do you think? As for the purpose, we have said already. The purpose of the budgetary control is to actually compare the budget with the actual activity to see whether we are achieving the purpose of the policy from which the budget has been prepared. And if it is not, what are the variances? And then action can be taken to correct them. Then what are advantages and what are disadvantages? These are assignment for you or things you have to try to work about. Now let's look at the behavioral aspect of the budgeting. Then we are saying that the concepts of behavioral aspect of budgeting denotes that mere understanding of the technical aspects or the planning framework of the budgetary process is not sufficient for management accountants. So once you are a management accountant, once you understand the process of preparing the budget, that is a technical aspect of preparing the budget. So you go strictly by, scientific means of coming out with the budget, making that you get the budget estimate and those things accurate. That alone is not enough for you as a management accountant. Nevertheless, the human, the social, and organizational factors which are involved at all stages in the budgeting are of critical importance and cannot be ignored. Have you seen? So the mere fact that we know the technical aspect of preparing the budget and that we can be able to come out with a correct budget estimate, that alone is not enough. In preparing the budget, you must also know that there is human aspect which is going to see to the implementation of budget, as well as the social aspect and the organizational factors. All these factors must be considered in coming out with a budget estimate. Subsequently, Lucy 2005, he posits that budgeting is not a mechanistic technical process. That means budget is not a strict kind of process where we want to get technical estimate. If we have been able to come out with a budget for, let's say, materials, 10,000, it should be 10,000. We should stick to it, and nothing can be done. That is going to be too mechanistic. Remember that budget is a human, it's a social factor. It's something that is going to strive with human and people who have come together. So societal issues come in, and the organization itself is a combination of factors that come together. So all these things must play. Therefore, budget, according to Lucy, is not a mechanistic technical process. Totally dependent upon the goodwill and the cooperation of the participants. Of course, if the budget we have already learned successful, okay, we have to know that the success of the budget depend on the goodwill and cooperation of the participant, people who are going to see to the implementation of budget. Thus, without the behavioral aspect, budgeting will become merely paperwork with no real impact on the operations of the organization, except perhaps negatively. So, because it's a paperwork, at the end of the day, after we have it will have no impact of the organization, and if it will do at all, it will result in a negative impact. So the ideal budgeting system is one that must encourage goal congruence. Here we are saying that, and when we say goal congruence, we are saying that there should be goals coming together, each and every individual workers, the managers in the various organizations, which have their own individual objectives, must all be brought together to align with the organizational objective. It's only when this is done that the budget can be successful. Thus, the goal of individuals and groups should coincide with the aims and objective of the organization as a whole. So when we say goal congruence, we are saying that the goal of individuals and the groups here, they are talking of the various departments who have their own aims to be achieved. All of this must be brought together in line with the organizational goal. Okay, this is an idea which is difficult to achieve completely. However, management must place some premium on the fact that organizational objective cannot be imposed through the budgeting system. It is not easy going to ensure that you bring together, or you let the goals of individuals in the organization, in the various departments, to coincide or to agree on a point. However, you must make an effort to do so, because if you do not do so, it will mean that you may be imposing the budget on the people. Okay, if the budget, the people who are implementing the budget see it to be an imposition, then the budget will not work. So we are saying that it is not easy. It is not an easy thing. It is very difficult making sure that the goals of individuals and organization, departments and things are brought together to align with the organizational goal. However, management must place some premium on this, because if you do not, organizational objective cannot be imposed through the budgeting system, okay, without regards to the influence of individual team and departments objective. So that is it. There is also growing evidence that authority imposed from above is less effective than authority accepted from below, and that goal congruence is highly improved when the top management adopt a participative budget approach in budgeting process. Of course, it's a fact, and it's common sense that when authority is imposed, definitely it's not going to work well. But authority that actually comes willingly from the people, when people accept to do something willingly, then it works better. Okay, so we are saying that there's a growing evidence that authority that is imposed from above is less effective. So if you want to ensure that the budget will succeed, then the people who are going to implement the budget, the participants, must be brought together, or must be made to take part in coming out with the budget estimate. And when that is done, definitely they will look at their individual interests and then come out with things that they think when the organization do will help them as well as help the organization. And so participative approach in preparing the budget is the best instead of imposition. Okay. So we are saying that the participative approach in budgeting processes, rather than the traditional style of management with its strong emphasis on hierarchy and authority. In fact, participatory is better than this management imposing. So that is what we go. Now, participation of the budget holders. So if budget is prepared and the people who are going to implement the budget, who are the participants. So we are saying that the participation of the budget holder can also promote understanding regarding the objective as well as the acceptance of the set target. When people are involved in coming out with the budget estimates, okay, this will just promote their understanding, because they will understand why those figures, those estimates, and why that objective or target have been set, because they are involved. So the participation of the budget holders can also promote understanding regarding objective as well as acceptance of the set target. The whole process of the budgeting preparation and subsequent performance evaluation by budgetary control are carried out so as to motivate managers rather than to create resentment and unfavorable reaction. So when you are thinking of coming out with the budget, this behavioral aspect of the budget, okay, which involve the process, which is the whole process of preparing the budget and the subsequent, because the budget is going to be used as an evaluation tool to control actual activities. But when the whole process of this budget preparation and subsequent performance evaluation by the budget control are carried out so as to motivate managers rather than just create it has to motivate them rather than, because once they are not part, they are not involved, it does not consider their interest, does not consider the interest of the organization, department and all that, the budget will bring about resentment on unfavorable reaction. So the functions of behavioral aspect of the budget is what we are going to look at. So the following behavioral aspect need to be addressed. The following behavioral aspect need to be addressed. The first one is the level of difficulty. Individuals must actually be able to achieve the budget targets. If they think that they cannot achieve the target, they won't worry themselves. Because if the budget is prepared at a level where no matter what you do, you cannot achieve it, nobody will kill themselves. Nobody will kill themselves. You hear them that we can't kill ourselves. And yes, they can't kill themselves because the target must be at a level that they can aspire to achieve. Yes, there's a limit to which anybody can go, no matter how strong the person is. We are not machines. We are human beings. We are not machines. So at certain level, you cannot go beyond. So if the budget had been set at a level where people cannot achieve it, then definitely you cannot work. All right. It must also not be set too low, so that people will beat the budget, because the budget must challenge. Because human nature is said that we work better, we produce when we are challenged. Okay. Somebody said, necessity is a matter of invention. Necessity is the matter of invention. So once you are challenged, okay, you will be able to work. But if the challenge is beyond you, you might not be able to do it. So that is it. So the level of difficulty is what we will also have to consider when you are preparing the budget. What this means is that budget needs to be set at some degree of difficulty if they are to motivate the staff. But if set too high, will quickly become demoralized. The employees will quickly become demoralized and may simply give up. Yes. If they are too easy, then people will beat the budget without ever exerting themselves. So the optimum level of difficulty will be somewhere between the two extremes. It shouldn't be too low and it should not be too high. We must consider an average performer, the level that they can reach, and then set the budget. The participation is also another aspect of the behavioral aspect. Okay. Now we have two approaches. We have discussed this already. We have top-down approach, where the senior management of each functional budget originate the budget targets may probably be too difficult and may not reflect actual day-to-day operating conditions, as management may be far removed from the shop floor of the business. Then we also have the bottom-up approach. On the other hand, is where the targets are fed, the budget targets are fed upwards from lowest level, and this may not reflect the longer-term strategic plans of the business organization and may be perched at a understanding level. Again, we are saying that somewhere in the middle will be necessary to ensure a reasonable degree and good fit with the establishment policy. So you see that these two approaches, they are all approaches of preparing budget. But you know, if the budget are prepared top management and see it to be an imposition, and they may see it to be something maybe managers want to use it to punish them. Okay. Involve the people, and then the implementers or the people who are going to implement the budget and impose on them like the top-down approach, it may not resonate with the lower level managers, because the top managers are not at the lower level and they may not know what exactly is going on there. So it may not resonate what are fed from the downwards level to the top. That may also some the behavioral aspect, the middle level, where you managers will come out with the estimate, even if the budget estimate comes from the lower level, management may also align it with their strategic goals or the policies to ensure that the budget is all rounded and everybody is participating in it. Also, we use the budget for appraisal. Okay, in using the budget for appraisal, staff need to be appraised only on factors over which they have an influence. Because if you blame people on things that is not in their control, you would demoralize them. So, and using the budget as a tool for appraisal, staff need to be appraised only on factors over which they have an influence. For example, materials may have an adverse price variance. It would not be practical to blame the purchaser if the goods were imported and the price movement had been caused by exchange movements. Of course, because the purchasing manager may not have control on exchange rates. So if the price of the material has gone up because these materials are imported and the price of the material has been affected by the exchange rates, then you want to blame the purchasing manager for being what? That is this. So you blame, you actually appraise based on factors that they have control over. Then also in the another aspect of the behavioral aspect here is the balance score. When we are preparing budget, when we prepare budget and we want to use the budget as a means of, motivating people, paying, let's say, bonuses and distance, we should make sure that the budget appraisal is on all the key success factors of the organization. We call that one balance score. Balance scorecard. Sorry, balance scorecard. So the balance scorecard says we are saying that budgetary targets need to be set to cover a wide variety of indicators. Indicators here, we are referring to the key success factors in the organization. For example, the customer service, financial performance, operational performance, okay? Operational performance, and then some key areas that we have to ensure that, because these key areas, they are the areas that if the organization is able to achieve success there, the whole organization will succeed. So balance actually refer to organization concentrating on the key success factors, such that we do not concentrate on one aspect. For example, in Ghana economy, there are key sectors in the economy that if the government want to succeed, you have to improve that. Okay, so these key sectors must be developed, must be developed as a whole, so that we see success. If once we concentrate on one aspect and leave the rest, the organization will not succeed. So success budget balance scorecard here says that budgetary target need to be set to cover a wide variety of indicators. If bonuses are paid are based on individual areas, staff will concentrate on these areas at the expense of others. So if you look at just one aspect and you consider there and you give bonuses there, other aspects be forgotten. So that is it. The last one is the non-financial factors. Okay, non-financial factors. So non-financial factors are the qualitative factors. Qualitative factors should be considered when setting a budget, but will be difficult to measure. So non-financial factors are those qualitative factors that should be considered when setting a budget, but it will be difficult to measure these factors or measure these factors. So for example, pollution of the local environment could be to the organization having a low budget for waste disposal, therefore skipping on environmental friendly waste disposal. However, this factor may not be captured in the budget. So another aspect is that, budgets are quantified, budget are a quantitative plan. And so, but when you prepare the budget, there are certain aspects that cannot be quantified, that must also be considered, like environmental pollution and all that. So these are the questions that you have to answer. So this is also good for theory purposes. So look at that. Let's quickly start with the Unit 5. And so Unit 5, we are going to talk about standards. How many of you are there? We still have only 3. Only 3 of you. Hello?
We are 6 in number.
You're about 6.
We are 6 in number.
Okay. Okay, because in addition to myself, okay, you are 8. Good. Right. So let us go on. I was talking about the Unit 5. So Unit 5 is about variance. And just as we have talked about variance in budget, you see, when you compare the actual results with budgeted estimates, the deviation or the difference between the budget and the actual is what we call variance. Now, so there is a slight similarity between budget and standard costing. Standard costing is almost the same as budget because they perform almost the same thing. But budget is prepared for the whole organization, or the whole activities, the ledger activities of an organization, but standard is prepared for a unit. So, but standard is a basis for coming out with budget. Once you prepare standards for each product you are producing, you can use the standard to now determine or to come out with the budget. All right. So we're saying that we are going to look at the concept of standard. And I believe you understand the word standard. Can you give me any definition or any meaning or understanding of the word standard? Edu?
Sir.
Yes. What is standard? Just English word standard.
Sir, standard can be seen as
Yes, sir.
like the general requirement of a particular thing.
A general requirement of a particular thing.
Yes, sir.
Okay, fine. Any other person? Is it Ampoma?
Yes.
Yes, Ampoma, what do you say about standard? Mm-hmm.
Yes, please. Let's say maybe unit of measurement.
Come again. Your network is not good. All right, so it's a unit of measurement. It's a unit of measurement. Okay, good. All right. So in session 1, we say standard is a system of financial control instituted in certain organizations to ensure prudent use of resources in the manufacture of goods and provision of services. Quantity and cost standards are set by managers for the element of costs and compared with actual activities, actual quantities and costs to see whether operations are within the limits set by management. So standards are yardstick, they are norms, they are criteria. Okay, it's a yardstick or a norm. Okay, measure, something that we use as basis to judge whether something is good or not. So if you look at the Ghana Standard Board, they actually have a standard for quality of things that are accepted in this country. So if anything you bring is not meeting that measure, that yardstick, okay, then we consider that particular product as substandard and therefore cannot be accepted. And so in life, we must all have standard for ourselves. We must have something that we are using as a measure for our performance. Okay, we must use something. For example, if you have a role model, if you have a role model in life, that role model becomes a standard for you, becomes a measure for you. It becomes something you are aspiring to. Okay, in cost and management accounting, there are standards. The standards here are grades that students get. These are standards. Okay, some standards are good, some are bad. So we have A, B, B plus, and all those ones. These are all standard sets. Okay, it's a yardstick. Even first class, second class, these are all standards people can aspire to. So which of them do you want to aspire to? So standard judge what, I hope you understand that. So many organizations prepare standard cost per unit of output. And so the standard cost, when we say standard cost, it means that we are going to prepare standard cost for material, labor, and overheads, because we are talking of those element of cost. The actual cost we are incurring, and then if the actual is different from the standard we said, we can look at the can be taken. Okay, standard are predetermined costs. Prepared costs or and from efficient technical efficient level of management, and it is prepared per unit, and that will be used to compare the actual cost we are incurring per unit can be taken. It's theoretical, mostly theory here, and so your understanding is the concept. Okay, most of the theory you can read them. So by the time we finish going through this session, you should be able to explain standards and standard costing system. So the word standard should be able to explain and the standard costing system. You should be able to describe the standard setting techniques when we are setting the standards cost per unit of an item produced, which is made up of the standard cost of material, standard cost of labor, and standard cost of overheads. This must be understood. The setting of this standard, and then also you must at least list 5 advantages and 5 disadvantages of standard costing. So by way of defining standard and standard costing, just as I said, according to Pandey 1995, standard has been variously been defined as a measure. Have you seen? It has been defined as a measure of comparison. A standard is defined as a measure of comparison for qualitative and quantitative values. A measure of comparison for quantitative and qualitative values. A norm, standard is a norm. It's a criterion of excellence. A model of example of comparison, like the role model. A model of comparison, example, a model or example of comparison. Simply put, Pandey goes on to say that, or goes on to state that a standard is a measure of desired performance. So when we say standard, it's a measure of this desired performance. So if something is substandard, then it does not conform to the desired performance. The predetermined criterion for evaluating the actual performance. Okay, so we are saying that the standard is a predetermined criterion, okay, for evaluating the actual performance. For example, if the standard cost per unit of a product is, say, 13.5, a cost center manager is judged on the basis of this standard. So if you incur costs more than this 13.5, then you have not been efficient. But if you're able to incur less than this, the standard is 13.5. So if you incur less than this, then you have been able to do well. So that is how judgment is going to go. So standard costing, on the other hand, is a managerial device. So standard costing is a managerial device of using predetermined costs for performance evaluation and control. So when we say standard costing, then it's a managerial device. It's a device that management use to actually come out with a predetermined cost for performance evaluation and control. It establishes the predetermined estimate of the cost of a product or service, which we call the standard cost. So the predetermined estimate of the cost of product or service is the standard cost. Collect the actual results, actual costs, and output data, and then compare the actual result with the predetermined and the differences, which we call the variance, noted for corrective measures. So if you look at the budget control aspect and standard costing are almost in line, because the budget control is where you prepare the budget and then you use the budget as a basis to compare with the actual result. And then if there are differences or variances, this information is made known and corrective measures are taken. The same way, when we talk of standard costing, hello? Who is this person? Hello? Hello?
Hello, Doc. Sorry,
Okay.
Doc.
Yo. So we're saying that the standard costing is a managerial device of using predetermined costs for performance evaluation and control. So in standard costing, management comes out with the predetermined costs per unit of the various elements of costs and compare this per unit costs, which are predetermined costs of the element of cost, with the actual results. The information are gathered with the actual performance per unit, and then comparison is made between the standard and the actual, and then if there are differences, which we call variance, will be made, and then corrective measures can be taken to bring the actual result to conform with the budgeted, with the standard cost. So that is standard costing. So we say in standard costing, it establishes predetermined estimate of the cost of the product or service, then collects actual costs and compare data, actual costs and output data, and then compares the actual result with the predetermined, and the differences are noted for corrective measures. Okay, so let us now take a look at the meaning of standards. And we say standard cost. When we say standard cost, is a standard cost. What is standard cost? So a standard cost is a carefully predetermined, or it's a carefully determined cost that a firm or organization set for its operation. It is usually expressed on a per unit basis. So standard costs form the basis for planning and controlling the activities of an organization, such as preparation of budget. So we use the standard cost as a basis for the preparation of budget, monitoring and evaluating performance. So standard cost, we can also define standard cost as a predetermined cost per unit of an item produced, which is set based on the various elements of cost, like the material, labor, and overheads. Now, types of standard that are normally set. There are four main types of standard that are set. These type of standard are one basic standard, the ideal standard, the attainable standard, and the current standard. When we talk of the basic standard, we are talking of the standard that is prepared for a long period of time, from which the current standard are developed. So these standards, which remain unchanged for a very long time, once they are established, they form the basis for preparing the actual results. They form the basis for comparing the actual result over many years, and thus making it possible to see the trend of the variance easily. So when we say basic standard, they are the long-term standard, okay, that are set by organizations from which current standards are developed. But mostly they are the standard that are prepared to remain fixed okay, for a very long time. So to actually look at, to judge the trend or so it's in line with the fixed budget. Last time when I was explaining the fixed budget, basic standards are in line with the fixed budget. They are prepared to remain the same for a very long time, so as to actually judge the extent to which the actual result will deviate from the standards. And mostly because it's the long-term standard, current standard are developed from it. Then we have the ideal standard. Ideal standard here is a standard that's supposed to be achieved if everything is done perfect. Ideal, you see the word ideal. Ideal means that the perfect situation or perfect condition is a standard that will be achieved under perfect condition, where there's no room for mistakes. Okay, there's no room for mistakes. So these standards, these are standards that can be attained under optimal operating condition, where no breakdowns, no wastage, no lost time are expected. Ideal standards are the most tight standards which demand perfect and extremely high degree of efficiency in the use of resources. Okay, so ideal standards are adjusted periodically when there are improvement in methods of production, technology, labor, and materials. Ideal standards are extremely difficult to attain in practice and are unlikely to be used for routine reporting purposes. However, a firm can meet the ideal standard set for its operations when all relevant operating factors occur as expected. An ideal standard is future-oriented and may be used for long-term development purposes. So ideal standard is the standard that are set under most perfect or most favorable condition that does not allow room for machine breakdown, wastage, loss of time, and whatever. May I ask, is there any situation in where this standard may have to be applied? Is there any situation in the organization setup where standard should be the one to set? Hello? Are you with me?
Yes, sir.
Yes. So we are saying that somebody wanted to talk. There's no breakdown, no wastage, no loss of time. Everything should work perfect. And this is a most favorable condition where there's no where so that we do not allow for any mistake, any breakdown in those things. Is there any condition, any organizations where this have to be done? Hello?
Yes.
Yes, so I want to know.
For me, I think for the production unit of a company, everything has and that there shouldn't be any room for wastage. Resources must be used to its maximum perfection. And I think
Your production setup, after production setup, is it possible you can ensure ideal standard production setup? Because there are certain things that may not be in your control, and for that you may want to allow for some breakdowns. Okay, it is not intentional that you are going to allow things to be, it must the that we must operate efficiently, but we must also take note that certain things may go wrong, and that we give some room for that. For example, in the normal production setup, sometimes you may take some to test. Okay, for example, if you are producing any beverage or any edible product, you may want to test to see whether the output coming is in line with the standards. It's okay. Now, when you use that one, it's not a perfect situation. Sometimes the machine will have to break for some certain repairs to be done so that machine can go on. So you can want to give some means to the past. So for production, manufacturing setup, definitely ideal standard may not be the best. But I wanted to draw your attention to a situation where you go to surgery room in the hospitals. Would you want to give room for, let's say, some light out or machine breakdown on something when somebody is being operated? So at that room, fine. That one, because human life is involved, we must give. For example, in aircraft business, the standard must be ideal, because any slightest room for mistakes, disaster will happen. So, but for normal production, we may be able to give those ones. So ideal standard may be useful at certain situations where we must ensure perfect performance without any room for mistakes and all that. Then the next one is the attainable standard.
Sir.
Attainable yes, please.
Yeah, so can the ideal standard be attained 100%?
Yes, 100%. Yes, 100%. No room for any losses. So we don't do normal loss. Normal loss should not happen. But in normal operations, normal loss can happen. For production level, normal loss. For example, those, if you go to ABC, sometimes visitors come, they take some of the product for them to test and those things. They incorporate that one as part of their normal production. So it becomes a normal loss. But in ideal standard, we want to 100% turn out. There shouldn't be any mistake. So in a surgery room, hospital where we are operating on people, machine supposed to work 100%. No room for. We should make sure the light is on. Everything, human being, there shouldn't be any room, because any slightest mistake, somebody will die. And then aircraft, certain places, we must make sure that we ensure 100% efficiency. Any room for any loss, problem comes. So that is the ideal standard. But in the normal business operation, ideal standard may not be. That's why we're saying that ideal standard is more difficult to attain in practice and are likely to be used for routine listening. So ideal standards are normally difficult to attain in practice, especially in manufacturing setup. Okay. So now let's look at attainable standard. Attainable standard here are standards which are based on efficient operating condition, but not perfect condition. Have you seen the difference between ideal and attainable? Attainable says that it is a standard that should be obtained based on efficient operating condition. We must operate efficiently. We should not think that we should not in ordinary think that machine is going to break down or we are going to give room for this. But we are saying that we must operate efficiently, but not perfectly, because perfect condition may be difficult to exist. They are attainable over a period of time and emphasize normality. They emphasize normality and allows for some deviation. So ideal standard allows for some deviations. Attainable standard, it allows for some deviations. Attainable standards aim to provide high but realistic targets. You see, attainable standard aims to provide high but realistic standard, because to say 100%, mostly is not realistic and should be based on high performance level, which can be achieved, performance level that can be achieved. They serve to motivate employees since these standards are possible to achieve. If you set ideal standard, it is not likely for people to achieve, because to ensure 100% turnout is highly impossible in manufacturing setup. But for attainable standard, we have to ensure that we are performing, we set the standard so that we can achieve it when we are operating efficiently. But we give room for some deviations. Then current standards. Current standards are the widely used in practice. Those standards that have been developed for use during the budget period. They are established for use over a short period of time to reflect current conditions. They are standards which are realistic and attainable under efficient economic and operating conditions for the operating period or for the coming period. So we are saying that current standards are the standards that have been developed for use during the budget period and normally reflect the operating conditions for the period and ensure that there's efficient economic and operating conditions for the upcoming year. There's advantages and disadvantages of standard. I don't know whether I should leave it for you to discuss them yourself, but the main advantages of standard costing include the following. One, standard costing system provide data which help in setting budgets and evaluating managerial performance. So if the organization wants to develop budget, if you have standard costing in place, it becomes easier to prepare the budget because the budgeted cost per unit is the standard. So if we have budgeted to produce, let's say 10,000 units, we multiply the budgeted cost per unit times the 10,000, you have gotten the budget for the period. Have you seen? So budget, the standards are per unit and the budget are in total for the organization. So the standards are used to develop budget as an advantage. It acts as a control device whereby actual performance is compared with the standard set and the variance analyzed for suitable corrective action to be taken. The essence of preparing the budget here, the standard is to ensure that we have a guide for what we are actually doing. So if you are in this world and you don't have any yardstick against which you are aspiring to, then you'll be doing anything anyhow. So one advantage of standard costing is that it is a control device. And if it's a control device, because we compare the actual performance with the standard, and the difference, which we call variance, are analyzed for suitable corrective action to be taken. Also, standard costs can be set or can be used in pricing stock issues and stock valuation as an alternative to FIFO, LIFO, and weighted average, simple average methods. You see, most times, some organizations, instead of using last in, first out, weighted average or simple average method, they may want to use a standard cost to evaluate stock. Okay, the firm has a standard cost of valuing its stock. So it can be used as an alternative for pricing of stock issues. I don't want to go through defining or explaining FIFO, LIFO, and those things. You have done that one in your cost and management accounting one. So I should assume that these things you know them. It also provides a prediction of future costs that can be used in setting selling price of a product. So once we have the standard cost, it serves as a prediction to be used to determine the price. Because if we want to determine price of an item, we need the cost. Okay. Once we know the cost per unit, you can just get the margin or the markup and add to the cost to get the price. So once we have a standard cost, then it can be used as a basis to determine the selling price. It also provides management with an early warning about possible losses and inefficiencies. Once we compare the budget, the standard with the actual, and the variances are made or are communicated, it gives management information about the possible losses. Because if we have set, let's say, cost of material to be, let's say, 10 cedis, and at the end of the day, we incur 15 cedis for material as actual cost of material, then definitely it gives us information to actually the actual, and we see that there's going to be problem. It also reminds, or it provides information to manage conformity in the costing of a product and service. Once we have standard costs, we will be able to, in achieving cost of a product and services. Disadvantages are that prices and efficiency change. Prices, of course, we set a standard of material, standard cost of material by multiplying the standard price by the standard quantity. But if or prices of them standard price we set for a short period may be useless or maybe meaningless. Now, setting of standard is extremely difficult and complicated in practice. For example, it is not possible to forecast costs as some of the factors which influence costs are very unpredictable. So coming out with the standard, you remember that we are saying that the standard cost itself is a predetermined cost. If it's a predetermined cost, then it means it's an estimated cost. Once it's an estimated cost, it's always very difficult to estimate the cost. Or even if it's a sales standard or standard company sales standard, it is not easy to estimate selling price. Okay, yes. So all these things are extremely difficult things to do, and therefore maybe difficult to set the standard price in practice. With the example has been given, it is not possible to forecast costs as some of the factors which influence costs are very complicated. Exchange rate, inflation, and then what they call interest rate and all that. All of these things influence costs. So then also there is inflexibility of standards, since standards have the tendency of becoming rigid over time, and frequent revision is difficult as well as expensive. Now we set the standard per unit, and this standard may be used over a period of time. The revision of this standard may not be that easy. That is also one disadvantage. And then the use of standard costing may be demotivating, especially where the standard sets are difficult to meet. Just like the budget, if you set standard targets, because the standards are so targets. So if you set the standard very high and people are not able to achieve the standard, I think they will be demotivating. It will demotivate them. So the standard can be a demotivating tool, where if it's set high and employees cannot achieve it, they become demotivated. Standard costing system may not be suitable to small firms where a detailed system of analysis may not be necessary. So sometimes for small firms, you may not want to use this standard costing because it may not be beneficial to them. Now, the certain standards, and this is a very important aspect, especially when you are learning not for examination purpose only, but for life. When you are learning for life, how to come about with the standards, because when you are employed as cost accountant or cost management accountant in any organization, and you are in charge of developing standards for the company, you need to be able to go through the steps that we have to go through in making. So that one I will leave you to read. It is not normally in your examination. So the self-assessment question here are: explain the following terms: standard cost, ideal standard, current standard. Describe 4 major types of standard. So state them and describe. Outline 4 advantages and 4 disadvantages of standard costing, and they also explain the procedure to establish direct material and direct labor cost standard. Right. So let's move on to session 3 and session 2. Then we'll look at the various standards that are set. Having looked at the definition of standard, the definition of standard costs, the definition of standard costing. Hey, my computer is going down. Let me just look for where I can charge it. Just give me a minute. I want to put it on charge and then we'll go on. Sorry, I'll be with you very soon. Hello, are you there?
So we are here.
Hello. Yes, so I'm sorry that my friend. Okay. So we are talking about variance analysis. So we said standards are set for the element of cost. And so we're going to start with direct material variance. Before we talk of direct material variance, I don't know whether you were able to go through this one in cost and management accounting 1. Standard are set for material costs, labor costs, and overheads. So when we are setting material, standard cost of material, we'll definitely get the price, standard price, and the standard quantity that we will use in producing that one item. And then we'll multiply the standard price by the standard quantity to get the cost of the material. So the actual cost of material. Okay, but this can be split into 2 because if there's difference between the material standard costs and the actual material, then we need to get that variance to see the cost, to find out the cost of the different variance. And so if you investigate further, then you realize that the material cost variance can be from the price difference or the quantity of material difference. Can be divided into 2: material price variance and material usage variance, or material quantity variance. Okay, so that's what we are going to go through. Then labor cost, the same thing. If you determine the labor cost variance, we are talking about the difference between the standard cost of labor and the actual. But to get the labor cost, we multiply the labor hours by the rate per hour. So therefore, if there is difference between the actual cost of labor and then the standard cost of labor, then this can arise, or this can be as a result of the labor rates being different from the standard, or the labor hours used being different from the standard. Okay, so we have labor efficiency and labor rate variance. So that's what we're going to do. So in this, by the time this question should be to calculate material price and material usage. And when we say material price, we are talking of material quantity. Usage, we are talking of quantity used. So material price and material usage variances, and interpret the results. Then we should be able to also compute the mix and the yield variance and interpret the result. Now, the material mix, so when we are using more than one material to produce an item, if we produce then also the standard quantity or the standard we have set for the material is used to calculate some number of outputs, that is the yield. If the standard yield differ from the actual yield, that also result in material yield variance. So we're going to talk about them. So the review of material usage and material price variances. So let us now revise what we learned in our cost and management accounting course. And material cost in cost and management standard costing. If we did not do, then we are just reminding ourselves, especially those who went to cost accounting, those who did cost accounting at SS level. If my daughter
your network, it's like so, you go and come, you go and come.
Come again. Hello.
Your network is breaking
My network.
continuously.
Wow, this network issue. Can you hear me now?
Yeah, we hear.
Hello.
Yes, sir, we can hear you, but when you are talking, you go and come. You go and come like that. It breaks. It keeps breaking.
Oh, is that so?
Yes. So I was thinking it's from my end, but I realized that it's from your end.
Okay. Okay. So let me just buy one other some more data and see if maybe that was why. But I have data. I have data actually. I have data. I'm just
Yeah,
buying one.
I don't think it's your data, it's the network.
It's not the network.
It's not your data, it's your network.
Okay. Yeah. It's the network. All right. So let us. We saw that material cost is equal to quantity times price. Just get the material cost, we multiply the price times quantity. So material cost is equal to quantity times the price per unit. And therefore, in calculating material cost variance, we can break it into quantity. I explained this already because we calculate or we determine standard costs of the standard cost per unit. And this standard cost per unit is made up of material, labor, and overheads. Now, when we come to material cost per unit, the material cost is obtained by multiplying the quantity we use per unit times the selling price. Therefore, if material cost is there's material cost variance, then this variance can be investigated from the point of the material quantity we use, which is called the material usage variance, or the material price we paid, which is the material price variance. So material cost variance can be divided into material usage variance and material price variance. We hope you remember the causes of the material price variances and material usage variances. Of course, what will cause the actual price being different from the standard price of material? We know inflation, substandard material, so many other factors. And then also the usage. What will cause the actual quantity we use for producing an item being different from the standard quantity we set? It could be that there's a change in the design, the material quantity, the material type is different. Then maybe the employees are not efficient and therefore they will use more than required and all that. Those are causes of material. We need to read about that. So for the purpose of computing material cost variance, the following abbreviations we are going to use. When you see MCV, that is material cost variance. MPV is material price variance. MUV is material usage variance. AQ is actual quantity. SQ is standard quantity. And AP is actual price. So take note of it. In calculation, we will not be mentioning these terms in full. We'll just abbreviate them as here. In examination, you can also do same. Instead of writing material usage variance, you can just read material MUV. Okay, once you write that, we'll understand that. So Then we said the SP is the standard price. Symbolically, now material cost variance, which is the difference between the standard cost material and the cost variance equals to the standard price of material times the standard quantity times the standard price minus actual quantity times the actual price. Remember that if you want to know the material cost, the difference between material, the difference between the actual times actual price. So if material cost variance, that is going to be standard cost of material minus actual cost of material, which has been given mathematically. Okay. Then material usage variance, which is the difference between the quantity of material we used and the standard quantity of material we specify for the output produced. That one is given by the standard price times the standard quantity minus the standard price times the actual quantity. Remember that one would say material, once we are saying material usage, then the difference is the quantity. So we assume that the standard price is constant, but the quantity is what differs. So to get material usage variance, it's the standard quantity of material or the standard cost of material minus the standard cost of the actual quantity used. Minus the standard cost of the actual quantity used. Standard cost of material minus the standard cost of the actual quantity used. So that's why we are saying that the standard to get the material usage variance is the standard price times the standard quantity minus the standard price times the actual quantity. So if you then factor the standard price, which is the same, out, then you have the material usage variance being equal to standard price into bracket, the difference between the standard quantity, the difference between the standard quantity and the actual quantity. In this case, we hold the standard price constant because that one is, we assume that that is not the one causing the difference. It means that the actual price and actual quantity, actual price and the standard price are the same. Therefore, we pick the standard price and then look at the difference between the quantities. So the material usage variance, in short, is calculated as the standard price times the difference between standard quantity and actual quantity. I hope you are seeing this. Then on the material price variance, we are looking at the difference in price. Therefore, we also hold the material quantity, actual quantity of material constant, because we're assuming that there's no change between the standard quantity and the actual quantity. That one is, so we pick the actual quantity, but the difference in price is what is going to be the difference. Therefore, actual quantity times standard price minus the actual quantity times actual price is going to give us the material price variance. And therefore, once we want to determine the difference in price, we factor the material quantity out. So actual quantity times the difference between standard price and actual price gives us the material price variance. So in examination, just quote the formulas here. Just material usage variance is equal to standard price into bracket standard quantity times actual quantity. Then material price variance is the actual quantity times standard price minus actual price. Right. Now let's look at small question here. You will be reminded that variance are either classified as favorable F and unfavorable U. That is what we know. So depending on its effect on the profit, for example, if the standard cost to make a batch of 500 units of a product is 1,250 and the actual cost incurred is 1,500, then there is an unfavorable variance because the actual so what we are so we don't say positive and negative. If it is positive, it is favorable. If it is negative, we say unfavorable or adverse. So in cost variances, if the actual cost is more than the standard cost, we say the difference is unfavorable because you are incurring more costs and this will reduce your profit. So if you incur more costs and it will have a negative effect on profit, then it's an unfavorable variance. But if the actual cost is less, if the actual cost is less than the standard, then this is a favorable variance because it is then going to increase your profit. So that is what we are saying here. So in this small question that I've given you, if you have the actual production cost to be 1,500, or let's say standard cost to be 1,250, and the actual cost is 1,500, then the difference here is unfavorable because this 150, this 250, which is the difference between the two. On the other hand, if the actual cost is then 1,000, if the actual cost is 1,000, then the 250 is going to be favorable because actual cost now is lesser than the standard cost. Okay, so there's a question here that the following information was extracted from the standard cost card and actual cost card of Anansi Limited in production of 500 units of a product. So the standard cost, we have the material A, B, C. Okay, material A, B, C, we have the standard price, we have the amount. These are standard cost. Then the actual cost card also have the varying cost of materials, quantity used, and then the price and the amount. Now, the question is, calculate the material cost price, and material usage, material cost variance, material price variance, material cost. So we are doing a calculate material cost variance, price variance, and usage variance for each type of material and interpret the results. So here the material cost variance for each type of material is here. Remember that we are saying that for material cost variance is the standard cost minus actual cost. So if you look at the standard cost, these are the standard costs and these are the actual costs. These are standard costs and these are the actual costs. Remember that we got the various costs by multiplying the quantity times the price. So quantity times price gives you the amount, which is the total cost. Okay, but in determining the material cost variance, we just take for example, if we take A, it is the standard cost here minus the actual cost, or you can say actual cost minus the standard cost. Okay, once the actual cost is more than the standard, that is unfavorable. And that will result in a favorable variance. Then if we talk of the C, there is adverse variance of or unfavorable variance of 6. So if you look at the question, that's how it is. So this is the actual or standard. Whichever way you do it, you know, subtraction is commutative. So you can make it standard cost minus the actual cost. it will also give you the same differences. The only thing you are describing, interpreting the variance, you look at the standard and the actual, which one is the higher? Because if it's the cost, if the actual is higher than the standard, the difference or the variance is called, it's an unfavorable variance. Unfavorable. So you know that one with you. Then if the actual is less than the standard, the difference is favorable. Then if the actual, like that's what I've explained. So if you look at this, these are the material cost variances. Now, these variances here could be caused by the price and quantity used. Okay, so this can be split into quantity and the price. So we start with the material price variance for each of the products. Remember that the formula we said, it is the difference. If it is the price, it's the difference in price times the actual quantity. How many quantities did we use? If you look at the quantities for material A is 420, material B 610, and material C is 280. Therefore, just look at the prices. So the formula is difference in price, that is standard price minus actual price times the actual quantity. So this was the standard price. The actual price is this. Look at them. So this is the standard price. Standard price. This is 3.5. This is 3.6. So the variance here is 1. And that means that actual is more than 1. The actual is more than the standard. And therefore, you multiply by the quantity. So you have, what do you call it? The difference here, multiply by this, and that gives you 42 adverse, because the standard, the actual is more than the standard. Then you come here, this one, the standard is 3, the actual is 2.8, and therefore you multiply by the quantity used, and that gives you 1.2 favorable, 122 favorable. Then we have the C, that is the difference in cost. So we have the standard to be 2.5 and the actual is 2.7, and the difference, you get it and multiply by this one and gives you this adverse. So these are the material price variances. When you come to material usage variances, the differences in the quantity times the standard price. So you have material A, quantity was, standard quantity was 400, actual quantity was 420, and so the difference times the standard price, that will give you 70 adverse. Okay, then for B, we have the difference to be the actual price, the actual quantity is more. So here too, the actual quantity is more, and that also gives you an adverse. And then the last one, here you can see that the actual quantity is less, and once actual quantity is less, it will give us a positive variance. So these are the material usage variance. Now, if you take A, just add the 42 to 70, and that is giving you 112. Okay, 112 to be the total material cost variance. Now, if you look at the adverse 30 plus the favorable 112, that will give you a favorable of 90. So if you add the material price variance and material usage variance, it should give you the material cost variance. This is what I'm trying to say. So the material cost variance is equal to the material price variance and material usage variance. And so if you add, I think this is a different thing. What I've explained to you here, this is supposed to be 42. They have 10 it. Okay. So you just add the material price and material usage. You see that it will give you the material cost variances here. Right Now, the next question says that the following activity took place in Abbas Company Limited during December, and the number of units produced are 800. The material purchase and use. Material purchase and use in production was 1,600. Cost per kilogram of material was 4 cedis. Of production, and the standard cost of the material is 4.2 per kilogram. You are required to compute the material cost variance, material price variance, and material usage variance. Have you seen? So here for material is 1.5. So to know the standard kilogram of material for this 800 unit produced, you must multiply the 1.5 by the 800. Okay, so that's what we have done. They have done here. That will give you the quantity. Now times the price. Price, we are showing that the standard price per unit is 4.2. So that's why you multiply the 800 by the 1.5 times the 4.2. Then the standard cost, standard cost of material. That one is the actual quantity bought. Actual quantity of kilogram we bought was 1,600, and the standard price, the actual price was 4. So that one is 1,600 times 4. And so you have the standard cost to be this and actual cost to be this. Once the actual cost is more than the standard cost, the difference is a variance. It's variance. That is interpretation. It's a variance. That means we have got it. Sorry, we have got it's unfavorable. It's unfavorable. It means that it will reduce our profit. Now we come to material. This can be split or can be divided into material usage and material price variance. Remember, I told you that the material usage variance is the difference of the material cost variance. The difference or the part of the material cost variance that is caused by the difference between the standard quantity specified for the output produced and the actual quantity used times the standard price. So here we have the difference in quantity times the standard price. And so this was the standard quantity. That is 8,000. How much is it going to be? Just 800, sorry, 800 times 1.4, 1.5. That's how much? 800 times 1.4 is how much? The 1.5. That is 1,002. So the standard quantity specified for the output produced was 1,002. Have you seen? Then the actual was so the difference is 400. difference in price can so 4.320, but this is favorable than the standard price. That's it. So it can be seen that
your network is not good at all.
right. That's what has been done here. Now let's talk of material yield variance
Sir,
and material mix variance.
sir,
Yes, please.
your network keeps on breaking, so we are not getting the concept well. You are teaching nicely, but
Hey,
the network.
what can I do? So then what do we do? Because then as for my office, the network was not coming at all. It is here that I came and it is coming small. Now it's like this. So what do we do? What do you advise?
Sir,
Edu? Yes. Sometimes when you are talking to, I can't even hear you because your talking is also breaking.
yes, sir. Yes, sir. Because of your network, that's why.
Hey. So are you suggesting we postpone?
Yes, sir.
Edu, what do you say?
So if maybe we can meet tomorrow and see her,
Okay.
so that we finish with it.
Even the mosquitoes are also chewing me here.
Sorry, sir.
All right.
Sorry,
In
sir.
fact, to at least move to at least maybe finish the unit 3, say session 3, so that tomorrow we can continue. Now, but if the network is not allowing us and you are not hearing anything too, what can I do? Pause. And then probably if we don't finish, I will set
Network is so quiet.
let's Kukua set and I'll
We didn't hear anything. No.
what
You didn't hear.
you did.
You were saying you will, then you went off. You didn't hear anything.
What is that? If by tomorrow we finish, now then he can record and send it to you.
We didn't hear.
You do get?
Okay.
Okay, then let it go.
Yeah. Hello.